Good afternoon, everyone. Today's March 31st, 2020. This is the final day of the first quarter of 2020. I don't know about the rest of you, but good riddance to it. As far as I'm concerned, the earnings will start rolling in next week, and I think that's going to be really, really interesting. And we've also got the employment report on Friday. So this is going to be very, very interesting times. Best time for you to come to the Options Tribe, which is our weekly webinar here at SMB. We hold it every Tuesday at 4:30 p.m. Eastern time throughout the year. And the purpose of the Options Tribe is to help to bring options information to you through options trading strategists and experts, also trading psychology, technical analysis, and any other skill or knowledge that can help you to improve your skill set as an options trader. That's what we're here for. That's what we're all about. Before we get started, I want to point out that SMB Training is not a broker-dealer. We're doing these webinars for educational purposes only. Today's webinar does not contain any live positions. Everything that you'll see today will be hypothetical and therefore not subject to the market factors of liquidity, slippage, and commissions. I also want to point out that options trading is risky, as is all forms of investing and trading, and so you shouldn't expose any capital at all to options trading until you're fully aware of those risks and have gotten a good education, done a lot of back testing and paper trading. And when you trade live, trade responsibly and at a very small level relative to your net worth and your net income for an extended period of time before you even consider increasing your capital's exposure to options trading. Because in the beginning, you're not going to necessarily understand how options respond to varying market conditions like the crazy ones we've been experiencing. And if you don't know how they're going to respond, you won't know how to strategize, and you'll be doing that on a large amount of capital, which will be a big mistake because you're going to get caught in situations that you won't know how to handle. So start small with capital for an extended period of time and save yourself a lot of money. All right, so with that, I would like to welcome, for not his debut presentation, but one of his presentations, and that is Dave Heinzen, who is a long-standing Options Tribe member, and he has presented on the Options Tribe before. A great guy, and he is going to be, his sidekick today is going to be John Locke. Hey, John.
Hey, guys.
And John is here because what Dave is doing is basically a derivative of one of John's strategies on the Super Simple Spreads program. And therefore, we felt, it would be good to have John here kind of as a co-conspirator for the meeting today. So, by the way, that picture, I just Googled cool car.
Yeah, that is not my car. Thank you.
And that's what came up. I think that's a pretty cool looking car.
It's a pretty cool car.
You'll need a pretty good winning streak on options trades to be able to afford that.
I'll have to ramp up size to that one. Right.
Well, only do so prudently as relates to your net income and net worth.
Absolutely.
Then I can agree with you. Okay. And so as those of you who were here before we started the meeting officially may have gleaned, Dave is a commercial pilot. He works for Southwest Airlines, and he is living proof that you can trade, that you can do options income strategies without sitting in front of your desk all day, because he's up in the air a certain percentage of the time, and therefore has to have created workarounds for his to be able to be a successful options trader at the same time trade, at the same time, have a busy lifestyle as a commercial pilot and, a family guy. So Dave, welcome back to the Options Tribe. John, welcome back as always.
Yeah. Hey, thank you. Thanks, Seth. I appreciate that. Thanks for having me on. And I feel a little bit like this is like I'm in Bizarro world, right? So if you're familiar with Seinfeld and the Bizarro world, it's like, here I am as the presenter here, and I've got my name in lights with John Locke after it. So that I just can't get over that. So I feel like I'm like the opening act. So we'll go with that. I'm the opening act to John Locke. So if there was
no, you are the act, my friend.
If there was no Super Simple Spreads, if there was no course like that, I wouldn't be on here today. So first off, I just want to say thanks to Seth and also to John.
You're welcome. So so everybody knows, I met David, I don't know how many years ago it was, at the M21 presentation when I did the live class in New York. Dave,
that's right. That's right. Yeah,
early 2014. So I met both of you at the same time.
That's right. That's right. That was was that long ago? 6 years ago, huh? 2000.
Yeah, I think it was February.
It's like a reunion.
Yeah, right. Exactly. It all kind of comes full circle. So again, it just kind of shows you what you can do with options. Here we are talking 6 years later, and still, being successful, still doing different things. I wouldn't say you necessarily do the same thing all the same time and expect the same results. We all know that you kind of have to adapt to the market, and especially that rings true now.
Indeed. And so, Dave, you can bring up your presentation.
All right, Seth, can you see my screen there?
Yes.
Okay, great. Now, first, before I start, guys, I just want to let you know that I am a father of 3 young children. I'm in the office right now with the door closed, but that could change at some point. Might get a little interruption, as most people around the country and the world we're all kind of huddled in our house right now, just like most people are. And so sometimes the kids are a little bit stir crazy. I think Jill's got them down in the basement right now. So Jill's workout place that she goes to, it's a kickboxing place. And so obviously it's closed right now and has been for several weeks. But every day they send out an email of a home-based workout. So I've kind of quarantined them down to the basement. I told them, hey, it's got to be quiet up here, guys. I know my wife wanted to get her workout in, so I think she's got the kids down there as well. So hopefully you don't hear any crashing sounds either. I don't know what they're kickboxing down there, but I'm safer upstairs here.
Okay, great. And I want to make sure everyone can see the screen. I got one comment from someone that they couldn't see it earlier. Can a couple folks just type into the chat whether you can see the screen? Just make sure there's no issue here. Yeah. Okay. That is great. It's very clear. People can see it. And right. Thanks very much. So fire away.
All right. Here we go. So we talked about this. Seth talked about the legal disclaimers, not an investment professional. What is it? People say, don't listen to a word I say. Don't believe a word I say. But after I tell you don't listen to a word I say, why don't I just tell you a little bit about my background, right? Because most people, when they come on to the Options Tribe, they'll talk for about 40, 45 minutes or so. And then after that, they'll then kind of talk about maybe their website or their trade or their course that they're selling. So what I want to do is ease everybody's anxiety. I'm not going to come through with some course that I'm selling or a website for you to go to. This is more of a feel-good type hour where I'm going to talk kind of high level, very broad brush, what I've been doing recently. And when Seth and I first started talking about this and he reached out to me, it's a kind of a fun story how this all came about, and nothing earth-shattering as far as how the trade works itself, but just kind of to give you the oomph and the push if you are an options trader, either beginner or experienced, and let you know that you can take it to the next level and tailor it and configure a trade to your liking, to your schedule. I've got a different schedule than other people, and everybody's got their own thing going on as far as what they can and can't do as far as trading. So for me, my background is I've been a buy and hold investor for a long time. Mm-hmm. As far as stocks, I got into options about 12 years ago, right as the 08-09 recession was going on. I was at work with a guy who we were discussing that he was doing very well in the markets, and I told him, no, I don't believe that. And he then told me how he was working with options. So that kind of got me interested a little bit in it as well. So for a little while after that, I kind of taught myself with some books and some webinars. And as we talked about early on here just a couple minutes ago, I met both Seth and John in early 2014, and with the M21 course, introduced to a lot of great friends here that I speak to. either on Skype or Slack or even through email. I've been to a lot of the different workshops. Seth and I have he knows me from the Option Tribe trading contest from several years ago. Mm-hmm. And so I came in, I think the year that I'm thinking of, Seth, I came in second as the money winner. Let's be clear, it was a distant second from Andrew Faldy. So that was when the net zero, I think, came around, and he was doing it on that. So that was a fun time as well. And as Seth said, I do have a full-time job, and I'm just here to kind of reemphasize that you can have a full-time job and trade options as well. And I've been doing that for years now. So what kind of trading strategies have I done? And I'm not saying that I am doing them now because...
Dave, could I just jump in for a second? I don't know if you're moving away from the mic or you just sound a little faint, slightly faint.
Okay. So how's that better?
That's better. Good.
Okay. So currently I'm not trading these kind of market neutral strategies. Mm-hmm. And so people might say, why? Well, that's because the SPX is sometimes running 100 points a day, 150 points a day. So that's kind of the exact opposite of market neutral. But in the normal times, I've done all the courses that we all know, like the M3, M3U, Rhino trades, the X4, different strategies, and the ROC. And most recently, I had good success with the ROC prior to this last month.
Yeah, the pandemic goofed that up. It was kicking for quite a while, wasn't it?
yes.
Yeah, although I want to say something, which is that every one of these strategies are built with the expectation that some kind of big thing's going to happen every now and then, and that is going to reduce the returns that year, right? I mean, and because of these big events, they work. In other words, you know what I'm saying, John? Like,
the strategy is still wonderful, and I'm actually still trading a ROC trade. Actually, but that's a nice adaptable trade. Right. But we're not making the big money with it anymore. We're just kind of scalping a little bit of money here and there. But yeah, right. What you're saying is exactly true. I mean, where these are designed to take advantage of the market as it sits most of the time.
Right, and so when you get a big explosion of volatility like we have, that's not going to go away in one day. That's going to be around as this market becomes a little more tradable for market neutral strategies. You're going to have that heightened volatility for some time. And that's going to help those trades be very successful. The reason why people pay for puts is because they never know when something like this is going to happen. And so a lot of our strategies are built around the volatility that's just sort of like inherent in the marketplace because there's always a potential for trades like this. So,
Seth, I like to say this is why we make money most of the time, is when things like this happen.
That's right. Right. The analogy I always draw is to insurance companies, which I used to work in that industry. So it's an analogy I draw on a lot, where if there were no hurricanes, nobody would ever buy wind insurance, right? You've got to have that hurricane, which is a losing year for the insurance company, but it makes it a long-term profitable business because most of the time you don't have a hurricane, right? It's the same kind of thing. So, okay, I didn't mean to jump in, but just wanted to clarify with people that just because the ROC, which has been a joke in terms of tremendous returns, had a bad month for some people, doesn't mean anything. In other words, that's built into the expectations of the returns on the ROC that something like this will happen periodically.
Right. You just have to go in, take your loss, and be okay with it.
Exactly.
And then wait for the right time to go back.
And take your loss. You got to take your loss. That's the other thing. You got to take your stops.
Yes.
Yeah. And otherwise, it can get out of hand. Yeah.
Right. And when I say market neutral, a lot of times people just go to price. And I know I said that as well, saying the SPX is moving 100 points either way. But it's also, when you say market neutral, it's not just price, but it's volatility too. And that's what we talk about a lot in these market neutral strategies, is that you're trading volatility and the expectation that the or realized volatility will be less than the implied volatility that you're likely selling. So it's fine to do these type of strategies if you think the volatility is now elevated and will sometime between now and expiration, that implied volatility will lessen.
Well, that's really the best time to trade these, right, David? When the implied volatility is high and the actual price movement starts dropping out.
Yes. Yeah. And we actually kind of saw that today, right? So the Russell was down single digits. Now I know the SPX was down more, but
yeah, that's crazy.
Yeah. So we're starting to see the volatility in the VIX come back down, but then you got to ask yourself, for how long are we going to get the second leg down?
And it plummeted today to what, 50, right? I mean, whatever it was. Right. These are ridiculous levels in the first place. So.
Right. So, and now we have with all these different strategies, what I like to call a car trade. And so where did it come from? Why do I call it that? Well, as I told John on the holiday virtual trader party, when I introduced this trade,
again, Dave, a little bit running a little faint there. I don't know if you're moving away from your mic or what's going on.
Well, thanks for telling me. I've got it right up here now. The trade comes. The name comes from another trader in the group who had something called the party trade, and she would set aside an amount of money each month and do a trade where when she won the trade, she got to spend all that money. Now, who wouldn't want a trade like that, especially when you have positive expectancy on a trade?
Yeah. And that's a fantastic idea too, David, and that really hit me when we were at the seminar and she was saying that, because I make this money and I never spend it. And I'm like, well, it's good to force yourself to spend money sometimes. If you do well, spend the money. It's good for you. Gives you a little boost,
Anyone who knows me knows that I'm frugal. I look for the best deal here and there, but you also have to live your life now. You can't just always think about the future and not live in today. So this is an example of me trying to be mindful, and it also gives me an excuse to go buy a car, right? So what I did, a little bit of backstory, is previous to this new car that I purchased, I had
this is the car?
This is the car. This is
the car of the car trade. Okay.
This is the car of the car trade.
All right.
Sitting in my driveway. And so prior to this, I had a 09 Honda Civic, and we purchased that brand new. We knew we were going to, like we do with all of our vehicles, we run it until the wheels fall off. And so that's the way you should do that, right? It's economical. All you had to do was change the oil and change the tires every so often. So I got to a point where, I was driving a lot for work, and I figured after 10 years of having this car, I deserved something new and something nice. And I didn't go overboard. This is a late model 4 Series that I looked around for, and I had saved up the money for it, just like our previous vehicles. I don't like to pay late fees or interest charges, so I had the money to purchase a car and just write a check for it. And that's what I planned to do. So I found this car and I told Jill, hey, this is what I'd like to do. And she, for those of you that know my wife, I think John said it best. He said that Jill is very direct. And I know he means that
in a good way.
In a good way. And she is.
As long as she's on your side.
Exactly. As long as she's on your side. So she went with me, and she was like, I want to come with you on this. So we went to the dealership, and I picked it out. We were going through the writing of the check, and the salesman says, well, let me bring our finance guy in here. He's going to tell you about the financing options. And I said, thank you very much, but I've got my checkbook here. Let's go ahead and just seal the deal, and I'll drive it home today with the title. And he says, no, we've got to do, it's just part of our deal. Listen to this guy, and he'll run through his spiel. So the guy came in, and he told me a little bit about what was going on and the different rates. And let's just punch your info into a computer. It comes back in a minute. And he's like, oh, congratulations. You got the... pardon me a second. That was our Alexa trying to beep at me in the background. So he runs our credit score, and I find that he's like, oh, congratulations, you get 3.9%. And so really, like I said, I'm not a big interest guy. So I know that's low, but I don't know what that means really, because for me, I don't ever do that. So I said, no, let me just write the check. And then in the background, I hear Jill say 3.9%. And so she's not an options trader, but she lives with an options trader. So she knows some of the numbers I talk about. And she says, can't you make that every month trading your options? And I thought, oh, okay. So now it's kind of like a competition here. So I kind of thought about it a second, and I thought, yeah, maybe I could do this. So
this was actually Jill's idea.
This was actually Jill's idea.
Very interesting.
That's right. Yeah. So what I did is I said, okay. And so at that point, I didn't know.
And David's thinking I should have bought a more expensive car.
Right. Yes, that's right, John. That's right. I thought, I'm a damn good trader. Let's crank this up a little bit. No, that's not what I said. But what I did is I just wrote the down payment, and we financed the rest for 3.9%. And so then I got home and decided, okay, what trade am I going to do? Because let's face it, I could do a rock trade, and if I got a full profit target, all I need is a couple of those, and I could pay this thing off. But that's not what I wanted. I wanted something that I think a lot of people here today may want, and that's something that's a tried and true base trade, something that is low risk but also low reward, but also in that it's a very slow moving trade. You don't have to be in front of your computer all day. Heaven knows I don't have the time or the desire to sit in front of the computer all day. This is something that it literally takes me a couple minutes a day. Some days I don't even look at it, right? Because you know where you are kind of inside your tent. And so going forward, I thought, okay, I'm not going to try to pay for this car with the trade. I just want to beat the interest rate. Okay, so it turns out the interest on the car over the 4-year or 5-year loan was about $1,800. And so that's what I went into this doing with my thinking. And so my version, it's my version of what we call the bull versus bear strategy, which is part of John's super simple spreads.
All right, where's Dave? Let me just hold before you jump into the trade guidelines. Anyone having trouble hearing Dave? I know I just turned my volume up and I hear him loud and clear. So anybody who's not hearing him, all you have to do is turn your volume up. And if you can, if you can't hear him, then it's some issue on your side.
Yeah, let me know if it's not coming through correctly.
I can hear you. I can hear you fine. Yeah.
Okay, great.
Good. So, and others are saying you're fine too. So good.
Okay, great. And if there's any other questions or either one of you want to jump in, please go right ahead. So this is kind of a similar style to all the different market neutral stuff we all know about. So anytime between 55 and 75 days out, we start the trade. I like to do it on a down day. Why? Because volatility is usually risen, and then you can get that put spread a little bit further away from the money. And the trade duration is about 30 days. This trade does not get close to expiration. Seth, I know you like that because you like the Rhino trade. Am I correct?
Yeah, I like lower gamma stuff. Yeah.
Right. So this is good. You're not going to get whipsawed big. Now, the problem, I'll say the con with this trade is kind of like the M3 or any of those other type where you have to define your risk and where you want to take your risk. And so it's to the back, it's for a market drop or an increase in implied volatility. And with this, you're only in it for 30 days. You're out with it, a long time before expiration. So you close out the current trade and open a new one when the back month or the next month is 55 to 75 days out. So there's no overlapping. I know a lot of people don't want to overlap. And so what I've done, and I kind of back traded this a little bit, but you'll also see that I do a lot of discretionary stuff with this as well. Sell a 30-point put spread in the Russell for about 250. And I say discuss what deltas. Now, John, correct me if I'm wrong, but in your course, you do such a thorough job of discussing all the different deltas that you could sell. And I think the meat of the story is that it really doesn't matter, right? Because, and I can't remember if it's percentage-wise or money-wise, but if it's at the money or like a 1 standard deviation or a 10 delta, they all will stop out at a similar spot.
Yeah. So So one thing we should mention too, David, is the type of trade, because just to give people an idea, we're talking about a bullish vertical with a butterfly or a butterfly behind the money, or what some people might call a bearish butterfly on top of doing that against the bullish vertical. So it's kind of like if you were to picture it, you'll see it in a minute, but it's like a bullish vertical with a butterfly on it. And when you sell a bullish vertical, one common misconception is if you sell it further from the money that you're less likely to get stopped out, but that's not really true. So generally we initially started doing 10 delta, but at some point I just said, well, why don't we just go for the credit, and we'll just take $2.50 credit wherever that happens to be. So I think that's what you're talking about here. Is that what you're talking about, David?
Absolutely. And so again, I guess what I want to make clear to people is that there's no magic pill, no holy grail. We talk about that a lot, where I need to know exactly, is it the 12.5 delta that I'm supposed to sell? And that it's not that at all. This is a trade concept, not a strategy.
The holy grail is making good decisions with that space between your ears, my friend.
Exactly. So then in a perfect world, after I've got that put spread on, we're preferably on a down day. Again, this is 65, 70 days to expiration. Sometimes I'll put the credit spread on and not do anything for a week or 10 days. I'll wait for an up day, something where the market is higher. And as you know, except for this last month, if you go back another 8 months, that's what this market's been doing, kind of gradually rising. So you wait for an up day in the market. That's when we love to buy our butterflies that are below the money, right? Because the value of it just gets crushed. It's a negative delta position. So as your price moves up, the price of the butterfly itself comes down. So 20, 30 points behind, and then you can fine tune your deltas to your view of the market. And that's where this not technical, but going with the flow of the market comes in. It's not a direct, you adjust at this delta or that delta. You kind of just have to have a feel for it. And
yeah, I think, you know what, it's an interesting thing, David, or something that I think that works well is basically you're essentially saying, hey, the market's been down a lot. It's likely probably to not go down too much further. Mm-hmm. Or, hey, it's been up a lot. It's likely to not go up too much further in the near future. So
exactly.
You're just taking advantage of that. Yeah.
You're taking advantage of it. And I'm not a super advanced technical analysis guy. I know how to plot support and resistance. I know my Fibonacci numbers and tools. It's a very easy thing to do once you get the hang of it. I know what the idea with technical analysis is. What you want to see is what everyone else is seeing. So if you're deep into the woods, no one else is going to see that. But if you have good support, good resistance where price has been before and other people see that, that's what I want on my chart. I don't want it cluttered. I don't want a bunch of what they call spaghetti all over my screen. Mm-hmm. And then so the put spread to butterfly ratio, I say is about 1-to-1, but I don't necessarily put them all at once. And so what I say is think bearish butterfly rules here. And again, the next slide will kind of show what I'm talking about. I just wanted to run through these guidelines first. So in a continuing up market, I might put that first butterfly 20, 30 points behind the money. And then once the Russell moves up another 20 or 30 points, then put one 20 points higher and then 20 points higher, kind of like a bearish butterfly. Or if I'm very convinced that now we're at resistance and starting to come down, I might put all three of the butterflies, 20 or 30 points, and then wait for that. But then that's me putting my view of the market onto my trade, and then I've got to be okay with that, and that's fine. It's kind of like you make your decision and you got to run with it. And then you also, once you do that, you have to say, okay, so where's my stop out point? I'm doing something specific. I'm making a specific adjustment. What's my exit point? That sort of thing. Mm-hmm. And so that's the upside adjustment. Downside adjustment is what I do is you can roll your butterflies back, or for me, this is just a simple trade. If the market goes down, that's where my risk is, and I'll talk about the exit loss trigger in a second. I just get out. It's an easy trade. I don't do a bunch of adjustments where I'm rolling puts up or single strikes up, or I'm not moving the put spread. So there's no profit target. I just exit when it's time to enter the following trade. And then the exit loss trigger is once I'm drawn down the amount of initial credit of the put spreads, not of the whole position, but just the put spread. So if you got 250 and you've got 6 put spreads on, I'm going to get out when I'm down $1,500, which is 250 times 6. And then, as we've said again, low risk, low reward. It's a low maintenance trade.
Mm-hmm. Yep. And I think there's something to be said, a lot to be said for that. You know what? The market starts. You have a strategy. You know where the weaknesses are. If the market goes against them, you just get out and try again. Because most of the time you'll be fine. Yeah.
Don't try to be a hero. Don't talk yourself into thinking the market has to come back because it's gone down 50 points today. If you thought that in late February, you got creamed.
That's right.
So what I did here is I just got a screenshot of showing what I mean, an in option view of selling the put spread. So you go down. It doesn't have to be a certain delta. It's a low delta. Right here we've got a 12 delta and a 10 delta. They're 30 points apart, and you're getting about 250.
So are you saying where you're placing the spread is more driven by the credit?
Yes, I know that's how it is in John's course, and then you can take that to kind of fit your own view of the market. If you want to come closer, if you want to go further away, you're going to get compensated differently for that. Obviously, if you go with a higher delta, you're going to get compensated more. Why? Because you're closer to the market and you deserve more of a credit. So this is kind of a middle ground. I usually will be somewhere between, say, 10 and 16 delta for the initial credit. And that was, Seth, let me tell you that was in the prior kind of 8 months or so. If you looked at this, if you went out 70 days today, I'm sure you could get further away from the money.
Oh, yeah.
It's going to be a whole different thing when the RBX is at 60 versus what it was at 15 or whatever. Right. So, nowadays, and this is something I just did this morning. So what is this? This is down at 830. So we're, 300 points away? And it used to be.
And this is day 45, right?
No, this is 45, yes, because as you can see, I had 45 and I had 80. So I didn't even have, my option view was acting clunky this morning. Go figure. Go figure, right? Option view is not clunky at all. Anyway, sorry. This is 45 days out, and I'm still getting 300 points at a 12 delta.
And you could have held that one, too. You'd still be good.
Right, because we didn't get down that low. I mean, oh my gosh, think about that. The Russell going to 830. I mean, it certainly could happen.
Yeah. I was selling naked puts at like $87 on the IWM, which is $870 on the rut, like crazy. So you're pretty safe there.
Yes, absolutely. Yeah. And so if you just do the bull spread, which is certainly fine, you get a delta of 6, and you can run with that. So what I wanted in this trade for me, for trying to beat the interest on the car that I bought, was something a little bit more neutral. And so with that, well, first let me show you what the graph looks like. And for those of you who've had Option View and know what a normal graph looks like, this is a little bit wonky, isn't it? Right? Because this is the volatility skews that we have today with the RVX. Usually this dotted line would be somewhere up here more and then come down here a little bit further. But since we have elevated vol on our long strike down here, it's pushing this side up, and we have more volatility on this short, which is pushing this side down. So this is more of a flatter line than normal. Okay, so then what I do is I'll couple it up with this butterfly that is 20 to 30 points away from the market. And you'll notice that it is negative delta, right? Because we had a delta of 6 point something, and now this is 5.5. So it's not very, very much negative delta, but then you can add as many butterflies as you want to fine tune that delta and get the risk graph that portrays your opinion of what the market is going to do. And so as an exercise, what I like to do is think, okay, what's the market done in the last couple months? And then what do I think is, based on that, what do I think the market can do in the next couple of months? And then we kind of do different scenarios and then make my position reflect that. And so this is with the butterfly attached. So the credit that you receive on this upper expiration line is now lower than it was before because you've bought this butterfly, but you've probably paid a whole lot less than normal for it. And we've got a little bit of a wonky line there as well.
So do you always have some credit left?
You know, once you get to, under normal circumstances in the last several months, once you get to 3 butterflies, Seth, it usually is pretty close to zero. So it does kind of bring that down. And then you just have to then ask yourself, okay, am I all right with, instead of having a little bit of credit on each side for a long distance, do I want a bunch more credit within by 3/10, so to speak?
Right.
Well, plus that credit's going to come back anyway because you're going to scalp the butterfly on the way down anyhow. So
right. Once you come back, that's the great thing about this is what would normally happen is the market where this black dot is, the gram dot, would kind of go up here for a little bit, come back, and then by the time you took the trade off, you were somewhere up here where the T+0 line is gone.
Right. I mean, you have to think dynamically when you see a position like this. It's not just what it is; it's how you're going to treat it as the trade progresses. So, if the market goes down, he's going to pull the butterfly. Probably, I'm guessing, David. I don't know your exact rules, but near the peak at a profit, he's going to pull a butterfly at a profit, and then the expiration line is actually going to be higher than it was when it started.
Because then you'll take the profit that you made from the butterfly and put it back on the upper expiration line.
Right.
Glenn is asking, does the butterfly and spread expire at the same time?
Yes, that's a great question. I had that in my notes, and I did not talk about that. So in the normal program, there are lots of rules and guidelines on the bull versus bear where you have to be at the Russell has to be up a certain amount or something like that, where you're rolling either the butterflies and or the credit spreads. And for me, my simple mind wanted something that I could just go in and out of. And that's nothing to take away from John's bull versus bear. But that's just what I wanted, is something a little bit on the more simplistic side, because this is not the only trade that I trade.
Right. Well, plus you are, I think this is important to point out too, you're actually making some sort of a subjective opinion on when to put these on. In the program, we're looking at it as if we have,
yes,
we're not looking at the market at all. We're just doing it blindly, right? Not knowing what's happening.
Well, right.
So we have other precautions and different things we do to help try to offset if you're wrong, so to speak.
Yes, and there should be like a caveat here that says someone just getting into this, I would caution them from doing it kind of this way, flowing with your subjective thinking, because a lot of times you can talk yourself into the herd mentality, and we all know what happens when you follow the herd. So get yourself a good education with the super simple spreads and learn how that process works. I didn't make this trade on my own. I made it based on rules that I followed for a long time and back testing the specific trades, the guideline trades, because you have to know how this trade works under specific guidelines that you've back tested and that you've live traded for you to understand how it's going to flow with the market. And so you kind of have to graduate to that. Am I right?
Yeah, I agree with definitely.
Okay. And then, so in a spreadsheet here, I don't know if you guys can make sense of this. I'm not a great Excel master here, but we've got different exits and shows the amount that could be made on a trade, and then each one or every other one is a car payment. So we know that that's fixed. The trades can kind of come and go. And again, the idea was not to try to pay for this car. It was just simply to beat the interest. And over the life of the loan, the interest on the car was $1,800. And in just a few short months, I think 3 months, I had made $1,800 profit. So at that point, I consider it won. You know, I won the game. I took Jill out to dinner and said, I beat the interest rate on the car, and now the rest is just kind of like gravy or whatever.
It's like a party trade.
It is. It's a party trade, and instead of having to slug 100 miles in my Civic, I get to do it a little bit more in style. And a couple of takeaways here on this slide is to show you. So yes, the car payment itself is fixed over time, but the amount that you can win or lose on a trade varies. And so if you just go a few short months after 2 trades and a payment, you could be down quite a bit of money, and then that can wreak havoc on your psychology. So you might say to yourself, "Oh, this isn't going to work. Let me hop to a different trade. Let me tweak this or tweak that." And you can't do that if you want to be a successful trader. After a certain amount of time, when you have been trading, you have positive expectancy. I go into a trade, actually feeling and thinking that I can win this, and that I know that it can lose, and I do lose. I take losses. I took several of them last month, and you got to be all right with that. But you also have to know that you go into it with a positive expectancy. And I think when you look at the M3 and all those different trades, and if you back test the heck out of them, you get 9 wins and 3 losses, average or something for a lot of those type of trades. So going in, you follow the rules, that's what you can expect. But that also means that you can expect losses. Like sometimes you tell people that, and they say, sure. But then when they take the loss, they're like, no, I'm out. I don't want to do this. This trading is for the birds. So you got to be okay with that. And so after that loss, I just jumped right back on the horse. And so at the end of 2019, we've got almost a $1,400 surplus. And that's not just paying the interest, that's paying the full car payment off. And so, we had this big max loss for the current trade that was on. And so even after that, after paying all the car payments, we're still about break even.
Right. That's not just the interest either, right? That's the whole payment.
That's principal and interest. Right.
Yeah,
so this car trade has turned into, Jill's idea was to cover the interest. You've expanded it to cover the interest and the principal.
Exactly. And now I'm looking at a Tesla. No, I'm kidding.
You've always been an overachiever, David.
So in the perfect world, you'll have all your original capital and you'll have your car, right?
Yes, that's the idea.
Yeah, that's pretty cool.
That's the idea.
We've got okay, I'm sorry. Go ahead.
No, I mean, I've got a couple more slides here that are just kind of me talking, but
I think one thing you point out that's important, David, and I think it's easy for a lot of people to miss because they're just kind of zoning out, is that you had a rough time with the strategy for a short period of time, but that's normal. It doesn't matter if you're going to do the same thing every cycle. You're going to have good periods of time. You're going to have some bad periods of time, and you're a lot better off. I think a lot of the challenges traders have at becoming successful is as soon as that little bad period comes, they go when they switch into something else.
Right.
And I think sticking with it is just of the utmost importance, at least for commit to yourself. You're going to stick with something for a certain period of time, a long period of time, and run the whole period of time, then decide if you want to use it or not.
Right. Not just bail out after a loss.
Exactly. And this is coming from trading. This has come from a guy who started traded options 12 years ago and still doing it. And John, correct me if I'm wrong, but you've talked to traders that have been in this for decades, and they're like still losing money. They're treating it as a hobby, right?
I have people who call me that I met in 2005 or 2006 when I was InvestTools, and they're asking me, and they're still struggling trying to make money, and they knew more about trading. They had 10 or 12 years of experience when I met them back then.
That's crazy, right?
Yeah. And they're still doing the same thing. They're looking for the next wonderful trade.
So that tells me it's psychology. It's like you said, John, earlier. It's what's going on between your ears.
Yeah. Exactly.
Well, why don't we jump in before you give your concluding remarks, Dave? Why don't we jump in and try to answer some of the questions?
Sure.
All right. So let me see. Let me just go back. Albert S. asked, did you stop trading the strategy with the current market environment?
Yes, great question. So along with the actual course, the super simple spreads, John has it's a VIX filter, an RVX filter above a certain number. And we've gotten above that, of course, right now. And what that filter does is it keeps you out of markets like 08 and the 09. And in the history books, they'll say in markets like 2020, right? So right now, I am not. I am doing some other things, and that's in the next couple slides. But this specific trade, I have kind of sidelined. And even when I modeled it up today, because the T+0 line is kind of crazy right now, I'm not excited to just jump right in to it right now. I'm kind of adapting with the market and saying, okay, this may not be the best time for this trade, and what can I do instead?
Albert S. asks also, can this strategy be done using OptionNet Explorer?
I'm sure it can. I'm not an OptionNet Explorer user. But just to kind of, as a side note, I really don't I just record keep on this trade in OptionView. I actually just use my mobile phone for this car trade.
Yeah, and just if I can throw in a comment, even in the super simple spreads program, with the bull trade, the bull versus bear trade, and the bear trade, it doesn't matter what analytical software you have. There's no delta limits and so forth. So
right. I never talked about a delta limit. It's really just looking at the T+0 line. And when you're doing something like this, it's not that big a difference between TOS and OptionView, or maybe ONE. I'm not certain with that.
Well, I think there's a difference in the T+0 line, but it doesn't really matter because you're not relying on that to make your decisions.
Okay. Yes.
Yeah.
Okay, the next question was from Robert, who says, have you back-tested this for shorter time frames, for instance, using weeklies or DTE of 14 to 21 days?
I have not specifically, but if you are inclined to backtest and look at something like this in current market, that might lend itself well to it, right? Because when you talk about volatility, Seth, if you're thinking about 2 or 3 months ago volatility, when you're looking at this car trade 65 days out, if you look at it today with volatility, you can get that same kind of profile and credit and everything probably at half that time, right? Because what happens when you increase volatility, it's as if the trade is further away. So if you could put on, say, a 30-day card trade, and it's going to act like a 60-day card trade, in theory.
Yeah, you know what I like to say about further from expiration trades is they buy you a cushion. So as you get
volatility could buy you a cushion.
Volatility can as well, right? So, as you get closer and closer to expiration in a more normal environment, then you have to be more and more right on your opinions if you're taking any kind of directional risk, which you are because you have gamma risk on anyway, so you're taking directional risk fast enough. But you have to be more and more correct with your opinions as you get closer to expiration. And it gives you a cushion being further away. And, Of course, the applied volatility does too.
Okay. So our case, April was a larger loss than the gaining months. Is there some rule on stopping out which would have capped the loss?
Right. That's a great point too. And that was one of my takeaways that I had written down to talk about, because you'll notice what I did here is I looked at the average gain and the average loss, and you'll notice that, especially with this current loss that, got bigger than normal. Yeah, one could say, hey, look, you're only making, say, $600 on your profits, and then you're taking $1,000 losses. So but you're also winning more too. So this is not a time-tested, back-tested for decades trade. It's more of a get you thinking, get your creative juices going to find something that can work for you. I'm not willing to, scale this up to be $1 million trade or anything. I think that's a valid concern that the two losses were bigger than the average gain.
Well, I'd like to point out a couple things, David. First of all, your edge more relies on your ability to make good decisions during the trade than it does by the trade rules itself.
Again,
so
yes.
And that's hard to backtest. That's where his edge is, though. And the other thing I like to point out too is whenever you say, "Well, I'm going to take a stop in the middle of the day," first of all, remember that you can take that 3 times maximum loss in an overnight gap. Number one. And number two, there's many times, or you have to go back. If you're going to say that, you have to go back and you have to count all the times the trade drew down to that point during the midday and then won afterwards. And you have to take all those wins away. And then you have to average everything out to see if that's even worth doing.
Right. Right. We've got another comment from Anonymous 10D. John, I think you said regarding the credit vertical, whether it's a 10 delta or much closer to the money, you're equally likely to get run over. Can you elaborate on that?
Yeah. So what are we doing with a vertical? If we have a vertical and our strategy is to take a credit and stop out at 1 times my credit, if that's our strategy, if you get closer to the money, if you look and you go very, very far away from the money with a vertical and you get a really hard down move, and you get to, say, maybe a 30 delta or a 20 delta, or even, I go as far as saying even an at-the-money naked put, and you go to this, and you take a look at how much distance it takes for you to stop out, they're pretty much the same. So from that respect, it doesn't really matter. The difference between going far from the money and going close to the money is the timing of the move, right? So you're almost better off being up close to the money if you get a down move first and then an up move. You're better off the opposite direction if you get an up move first and then a down move. So it's all has to do with timing. And if you're going to arbitrarily enter the market at X delta, it really doesn't matter if it's at 10 delta. Like when we did the Super Simple Spreads program, one of the things that I did, and I show the results of this, is I did a 1-to-1 risk-reward ratio, naked put, 20 delta, a 30 delta, a 60 delta, and what we have here, 250 credit, and ran them all, and they lost and won at different times, but over the whole period, the actual results and return on your risk was virtually identical. Didn't really matter. Win rate was virtually identical.
Right. Yeah, and that makes sense. At the end of the day, a lot of the lots of different strategies, sometimes radically different strategies, all end up having approximately the same return, I've noticed, depending on the structure of the strategies. but there's a whole family of strategies that tend to have one set of returns, another family that tends to have another set of returns, almost regardless of, the exact rules.
Well, if you take a Rhino and an M3 and you go take long-term return rates, they're the same.
Yeah, they're going to be very similar. Yeah, even though they're really traded quite differently in some ways, but there's an underlying similarity to them that give you the same basic results. That's right.
Yep. Yeah, they might win and lose in different cycles and different months, but long-term they're the same, which brings you back to the person who switches strategies.
Yeah.
And is always on the losing side of the trade.
Yeah, right. Yeah, I did a video about that a couple of weeks ago about how, a lot of times when you leave a strategy is when it starts performing its best. And when you join the new strategy is often when it goes into its, so then you're a loser, right?
Right.
It's not whether you lose in the trade, it's whether you're trading like a loser, right? Trading like a loser is just hopping from the hot strategy to the hot strategy to the hot strategy. And guess what? They always get cold as soon as you hop to them.
I had a client for years who was with me, and he just couldn't make money, and his method was that. He'd be trading a bull trade, and it would take a couple of losses, and the bearish butterfly would be winning. So he'd go over to bearish butterfly, and by the time he got over the bearish butterfly, the bull trade was winning. So or an M3 was winning. He'd jump over there, he'd do the next thing, and he says to me, he goes, I just want to get profitable. I just want to make money. What do? I said, pick one strategy, any freaking strategy. I don't give a crap what it is, and keep doing it.
Yeah, exactly.
And you'll be fine over the long period of time.
You'll be much better off than what you've been doing, for sure.
Right. Yeah. I mean, a list of 20 good strategies, right? Take any one of these. I don't care which one it is, and just keep trading it, and you'll do fine. But he couldn't get himself to do it, and but that's the one thing you have to do. That's it.
All right. Well, Dave, I'm sorry, we just got so into answering the questions. Why don't you finish up your remarks, and then we can talk about some other stuff. Yeah, go ahead.
I've got a couple more, but I'll just go to the key one. What we're for me, what I'm doing right now is I want everyone to know that I don't have everything all into my options portfolio, and you shouldn't either. So make sure everyone is trading at the appropriate size. And for me, it's hard for me to just talk options because why do people trade options? They'd like to do it for the income, for the money, whatever their answer is. And to me, that means taking a look at your whole portfolio. So the idea here is options are great. And in addition, find other assets, find other streams of income, because we're all in this money game, as Tony Robbins would say, to get to a point where we don't have to work anymore, and you don't do things based on money or how much it costs because you're taken care of. So make sure you're looking at your whole portfolio, especially in times like this when like a recession is maybe coming. So diversify. And of course, we've all heard the Warren Buffett quote, be fearful when others are greedy and be greedy when others are fearful. But it really speaks volumes in this current environment. And for me personally, that means I've had cash on the sides that I'm taking in stages as the market has come down to add to a long portfolio. Don't forget to look out for the long term. Whatever the current market is right now, it'll eventually pass. And so for me, what I've been doing is some calendars, which I haven't done for a long time. That was something I learned a long time ago in the kind of theory type classes that everyone takes when they're learning options. But the double calendars have been working well for me, and it's much smaller size than, say, I'll do an M3 or something like that. But Paul, who was on John Locke's one of the sessions here recently, is a super good trader, and he's been having some success with those as well, and I've been talking with him about that. Some long leap calls combined with short-term calls and call spreads. For me, that's worked well in some individual stock names where you can go out on, say, a long-dated call, maybe a year or longer, and then sell short-term higher out-of-the-money calls against it monthly, so you can maybe make some monthly profit. Of course, that comes with my thinking of, okay, in another year or two, hopefully we're on the back side of this. So get into some leaps where you're not paying a whole bunch of theta. If you're in a very deep in the money call, you're just taking advantage of the potential upside, and then call spreads. So you can jack up your returns again if you're right by not only selling a next month call against your long. Say you just had one call, you could sell several call spreads against it. Say at the 15 delta or the 10, the magical quote unquote 10 delta, something like that. And then another thing I've been doing at a very small size and kind of back testing is call side BWBs, which is kind of the opposite of what we've all done for a long time. Instead of doing, say, like an M3U, if you can picture that, put spread or a put condor behind the money, now doing a call condor ahead of the money, because then your risk is to the upside instead of the downside. If you had a big down day, you don't have that risk to the downside. Of course, all your risk is to the upside. So what I've been doing is I've been doing that on the SPX. After a big update, the market goes up 150 points on the SPX, I'll put a couple of these on and then fine tune the deltas. You'll actually have a negative delta. And then like today when the market came down, I got out of several of those at a decent profit. And then the last thing I'd like to say is I can't wait to get back into the rock style.
Right. For normal times to return.
Yes.
Yep.
Very good. Was that a wrap,
yes.
Dave? Or?
Yeah, that's a wrap. Thank you, guys. Thank you both for having me and listening to me wander here for the last hour.
No, you didn't. No, not wandering at all. It was great. And
lots of awesome information there.
Yes. And before everybody goes, the course that this whole program was based on, this whole theme was based on from Dave, was John's Super Simple Spreads video course. And John, just on a real high level, could you just kind of give us a little blurb on each of the strategies? It's 4 different strategies is taught in the Super Simple Spreads video course. You want to just kind of give a little blurb on each one?
Yeah, sure. So we have 4 strategies. We have the bull strategy, which is kind of what it sounds like. It's good for uptrending markets, lower volatility markets, that type of thing. And, the good thing about this is a simple strategy. We're able to test it since 2002. And we also cover this in our own meetings. So we cover it every month on, how it's doing and so forth, regardless of the environment. And you can see the expectancy over time, and it's a great strategy there. We have the bear trade, which is somewhat similar to a bearish butterfly, but it's more simplified and easier to trade. It's made for a more bearish environment than the bearish butterfly. And basically we have an entry filter on it, although I do tend to use that trading strategy a little bit more subjectively when the market is not likely to go a whole lot more higher. That's a good strategy to use. And then we have the bull versus bear, which is similar to what the cart trade is, where we put a bearish butterfly on top of a bullish vertical at a certain ratio of spreads. And that takes advantage of our more neutral markets. And then we have the V Condor, which is going to work well in our lower volatility, more sideways markets. It tends to do really well, especially if they're uptrending. So they're all great strategies, and like I said, we've been at it for a long time with them. So
that's right. So the Super Simple Spreads course, unlike John's other courses, he teaches a single strategy or a single system, I think is a better way to put it in some cases. But with the Super Simple Spreads course, it's actually 4 discrete strategies that are taught. They're all simple to understand, and they're all within the same course. And that's what Dave kind of based his thinking on in what he developed for his car trade. So what you want to do is go to optionstribe.com, and if you're interested in the course, if you go to the option strategy training courses and mentoring, in other words, you get to optionstribe.com and you scroll down to the options strategy training courses and mentoring, the Super Simple Spreads course is the 4th one down on the right. That's the one you're going to want to look at if you're interested in the course. Now, I'm going to do something goofy, which is, I haven't even told John about this, which is we normally, we were not planning to do a special on the Super Simple Spreads program because we thought in the middle of this virus and, it just didn't feel right to kind of do an offer on this program with everyone in, chaotic circumstances in their lives. But if enough people are interested in the course today, contact me and I'll make you a deal basically. John, I didn't even plan this, but I saw, so many people attended and and if people, really like what they heard, I'm going to give you my email address in a minute and just contact me and I'll work something out that will be somewhat equivalent to what we've done in the past.
Another thing too, if you're not learning now, if you're not trading now, you might as well be learning. And I think everybody should be in this on paper, trying to trade it real time.
Yes.
Like in an option view system or something, so that they understand how things react in this market, because it's probably going to happen again at some point in your trading future. And you might as well learn it now.
You could have a period where the market returns to quote normal for a while, and then another ramification of the coronavirus bangs the market down again. And that
could be anything. I learned to trade in 2008.
Yeah, that's right.
These systems were developed in 2008. They were developed in the market crash. So this doesn't bother me.
2011 was basically what happened in 2011 was basically based on what happened in 2008, 2009. It was a weakening of the entire financial system, and that had an effect of reducing the sovereign state European debt ratings, basically, and the U.S. debt rating all were weakened because of the recession of 2008, 2009, but it came out in 2011. So, if you're going to have a period where you're not trading as much, as John says, you might as well take advantage of that time to learn and see how these strategies react in these kinds of markets. I'll give you my email address right away, sfroiberg@smbcap.com. If you're interested in the course, shoot me an email. Take a look at the information page first. If you're interested in the course, shoot me an email, and I'll work out some kind of a discount for you. Okay. We also have a bunch of strategies for developing traders, and you'll see Super Simple Spreads is on that list. We have intermediate strategies for guys who are somewhat more experienced but still developing, and then we have advanced strategies, which are John's more advanced work, the ROC, the M21, and John Locke's Masterclass series. Again, anybody interested in Super Simple Spreads, send me an email, sfroiberg@smbcap.com. I'll work a deal for you. And in the meantime, Dave, great presentation. John, thank you so much for giving us the color commentary. I want to thank everybody. Really good attendance today. Really appreciate that very much. Dave, thanks a million. Really appreciate it.
You're welcome.
In all your business schedules, really appreciate all the help. Really appreciate everyone's attendance. Dave, John, thank you.
Thanks, guys.
Take care. Good night.